Hey everyone, and welcome to our explainer. Today, we're diving into an investment strategy that has the power to create some truly life-changing wealth. We're talking about ultra-high growth investing. These are the kinds of stocks that can deliver just mind-blowing returns. And we're going to break down exactly how they work, and, just as importantly, the big risks you have to know about.
So, to get started, let me ask you something. Think about some of the absolute biggest names out there. Companies like NVIDIA, Amazon, Google. What do you think is the one thing they all have in common that drove their insane success over the past decade? The answer? Well, it's probably a little more specific than you think. If your first thought was just, they performed incredibly well, you are definitely on the right track. And when I say incredible, I mean just look at these numbers. It is staggering. We are talking about thousands of percent, and in NVIDIA's case, over 30,000%. This is the kind of growth that can totally transform a portfolio. But why? What's the secret sauce here?
And here's the answer. They're all ultra-high growth companies. What does that mean? It means their revenues have been climbing at this really strong double-digit pace year after year after year. A lot of times, it's really about the acceleration of that growth. Take a company like Palantir. When its growth suddenly accelerated from 12% to 48%, the stock just took off like a rocket, with gains over 2,000%. That is the kind of game-changing potential we're talking about. But, and this is a big but, with that kind of reward comes some serious risk.
And that brings us to something that is absolutely crucial. Before anyone gets swept up by those gigantic numbers, we have to talk about the other side of the coin, the peril that comes with the promise. There are two major warnings you absolutely have to get your head around.
Warning number one is a big one: major volatility. These stocks do not go up in a nice, clean, straight line. They have these dramatic, gut-wrenching corrections and crashes. Our source puts it perfectly with this analogy. If you're not mentally ready for those huge swings, you're like an ant on a waterfall. You are gonna get thrown right off. It happens to every single one of these companies.
Okay, and warning number two is high valuation. When you look at these stocks using traditional metrics, they almost always look expensive, sometimes really expensive. And the key is to understand why. So our source gives us another brilliant analogy for this. Think of a normal stock as a Honda Civic. It's reliable, it's affordable, it gets you from point A to point B. But an ultra-high growth stock, that's an F1 car. It's built for a very special, very high-octane kind of performance, and you just can't expect it to have the price tag of a Civic. It's expensive for a reason. So now that we have that framework, the promise and the peril, let's look at some real-world companies. We're going to start with a few that are totally rewriting the rules in the consumer world.
First up, Celsius Holdings, the energy drink company. And wow, that 700% return over 5 years is exactly the kind of jaw-dropping outcome we're talking about. But the journey to get there, it was a perfect, and I mean perfect, illustration of that ant on a waterfall volatility. To see these gains, you would have had to hang on through some seriously wild swings.
So what's actually driving this? Well, after a bit of a slowdown, Celsius came roaring back. You can see the story right here on the chart. They had some distribution hiccups, but then revenue growth just exploded, hitting 83% in the latest quarter. A huge part of this was a massive distribution deal they signed with Pepsi, which is setting them up for huge expansion not just here in the US, but all over the world.
All right, our next consumer disruptor is ELF Beauty. And again, the result just speaks for itself. An incredible 551% return in 5 years. Their whole strategy has been a masterclass in modern business. They combine really affordable cosmetics with this huge social media presence and some incredibly smart acquisitions.
And this right here just shows you their potential in a nutshell. ELF recently bought Rhode, which is Hailey Bieber's skincare brand. On its very first day at Sephora, it completely shattered records.
We're talking a reported $15 million in sales, even outperforming massive celebrity brands from Rihanna and Selena Gomez. That is what you call explosive demand.
Okay, so you might be thinking, all right, this explosive growth thing, that's just for smaller up-and-coming companies, right? Well, what's so fascinating is that some of the biggest, most established tech giants on the planet are still running in this high-growth race. And the best example of this is probably Meta. It's maybe the biggest forgotten growth stock out there. Because the company is just so enormous, I think people forget that it's still consistently growing its revenues at over 20% a year. It's an absolute monster hiding in plain sight.
Our source actually laid out a few possible scenarios for the stock. In what they call the base case, with 15% average revenue growth, the stock could still more than double by 2029. And get this, even in the bear case, say a worldwide recession and only 10% growth, the stock is still projected to beat the S&P 500. It's all driven by their insane current dominance, plus their huge future bets on things like AI and the metaverse.
All right, next up in tech is AMD. For years, its story has been completely tied to NVIDIA, which just got out to this massive lead in the AI chip race. I mean, you can see it right there in the 5-year returns. But that whole story is changing. AMD is no longer stuck on the sidelines. It's in the race now, and it's catching up fast.
In this chart right here shows you exactly why that story is shifting. Just look at that acceleration. Only 6 quarters ago, its revenue growth was just 2%. And now, it just hit 31% in the latest quarter. The source here believes analysts could be underestimating this whole comeback, just like they did with NVIDIA at first, which could create a real opportunity for the stock to surprise everyone.
Okay, for our last set of case studies, let's look at a couple of companies that are really trying to position themselves to be the next generation of leaders in their fields. First, we've got SoFi, the fintech company that wants to disrupt traditional banking. And for them, the number you gotta watch is right here, member growth. They've jumped from 8.7 to 11.7 million members. That's 3 million new customers in a single year. That's a huge sign that their online-first model is really clicking, especially with younger people.
And this is the whole thesis behind SoFi. The real win isn't today, it's decades from now. Think about it. When a bank gets a new customer, the value of that customer just compounds over time through savings, loans, mortgages, investments. Each one of those 11.7 million members is a potential compounding machine for SoFi for years and years to come.
And we've got a quick honorable mention for Cava, the fast casual restaurant. The idea is super simple and really powerful. Just think Chipotle, but with Mediterranean food. Their growth is undeniable, consistently hitting over 20% every single quarter. So what's the catch? Well, it's at F1 car price. Its valuation is very, very high right now, which is why our source is keeping a close eye on it, but is staying cautious for now.
Okay, so after looking at all these different companies, from drinks to makeup to AI chips and banking, what's the big takeaway here? What are the common threads that really tie all of these together?
Well, when you look at all of them together, you see a really clear pattern emerge. They all share these key characteristics. That rapid and accelerating revenue growth. They're all clearly disrupting their market, and they all have this massive future opportunity ahead of them. And, like we've said over and over, that incredible potential is always accompanied by high volatility and high valuations. You simply can't have the F1 car's performance without the F1 car's risk and its price tag.
And that really brings us to the final question, doesn't it? Investing in these kinds of companies is exactly like getting behind the wheel of that F1 car. The potential for incredible speed and incredible reward is definitely there, but so is the risk of a spectacular crash. The question you really have to ask yourself is that a race you're built for? Thanks for joining us for this explainer.